It's time for Wise Money with Korhorn Financial Group with certified financial planners Kevin Korhorn, Mike Bernard, and Josh Gregory.
Welcome to another episode of the Wise Money Show with Korhorn Financial Group, where every week we're helping you take your next wise step in your financial life. Thanks for being here, friends. My name is Mike Bernard. I am your host. I'm also one of the certified financial planners on the program. And with me in the KFG studios, my business partners and fellow CFPs, Kevin Korhorn and Josh Gregory.
Hey, what's the optimal amount of stocks to hold in your portfolio during retirement? Conventional wisdom says that you should reduce your exposure to the stock market as you age. But does that standard advice hold up if your stocks are paying enough dividends to cover your living expenses? We're going to answer that question and more on this episode of The Wise Money Show.
Yeah, gosh, that used to be the thing. You know, the three-legged stool? I mean, you had your Social Security, you had your pension, and then you collected dividends from your blue chips. If I can, like, that's what Grandpa did. And it's more rare these days, but great question from fan of the show. Should that be what I do? So we're going to hit that and a lot more questions. If you have a question for the program or need any help, we are here for you. Call or text us, 574-222-2000. That's 574-222-2000. Online, wisemoneyshow.com is where you can find us. Reach out to us there as well. And then all over social media, wherever you're at, we are there as well. Search The Wise Money Show. Okay, before we get into those questions, tax season wrapping up this week.
Yeah, final stretch here.
Yeah. So if you haven't filed, if you heard that and make sure you're getting that.
I have to do that again this year.
Make sure you're getting your extension filed. And here's the thing, and this is super confusing. When I was first starting in this business, it didn't make sense to me. It just doesn't seem logical. You get an extension to file your tax return. You don't get an extension to pay your taxes.
Right.
Yeah. So when you think of April 15th, think of the tax payment deadline. So not only is that what I have to pay taxes for my income for the prior year, but I also, if I'm estimating, I have to write an estimate for what I made so far in the first quarter of this year.
Yeah, there's a reason why April 15th has earned a reputation of being such an unpopular day during the calendar. You're exactly right, Kevin. So I just consider this, I guess, public service announcement. If you're not ready to file your tax returns and you haven't filed an extension, you need to get that handled. Work with your CPA. Make sure that they've done it for you. But then also, are you confident that you have paid in enough in taxes so that when you do get around to filing your tax return, you're in a refund mode as opposed to having to write an additional check plus interest and penalties because you were late?
And the other thing, we just public service announcement, if you filed your return and in there solemnly swore, I will fund my HSA for last year. I will fund my Roth IRA. I will fund that 529 plan. You have until April 15 to do it. You filled out your tax return and said, I'm going to do it. But if you hadn't done it fully yet, then you got until what is it, Tuesday? You've got until the 15th. So make sure you do that as well. And then lastly, now's the time. If you don't have a clear tax shelter strategy, if you don't have a clear tax plan for this year, 2025 already, you need to run, don't walk. You need to be working with your CFP, figuring out what's our approach for taxes this year.
Yes. And just if that was not confusing enough, there actually are some things that you can fund. Some of these things, like Mike, you mentioned the HSA or an IRA or a 529, depending on which state you live in, those have to be funded by your tax payment deadline. Some other things like an SEP contribution or some other types of things, those need to be funded by your tax filing deadline, including extensions. Mm-hmm. Yeah. So this is where if you have a super simple financial life, you might say, hey, I'm going to go it alone. I don't need any help. But if you've got any complexity to your financial life, make sure you've got a professional guiding you. And we encourage you to work with a planner. Make sure they're certified and get the help you need.
That's right. While we're talking tax preparation, tax planning is completely different. It's connected, smells like it, but
it sure does.
Yeah, but it's the proactive work. It's the creative work. So, all right, let's shift into questions from fans of the show. I've got several here. We're going to start with the doozy. I got this question from John on the YouTube channel a couple months ago. Hey, Mike, thanks for the video. I'll be retiring in about 10 months. Hey, congratulations. I will have enough Social Security and pension to cover all my monthly bills, mortgages paid off. My investments are mostly in my company stock, which includes dividends that are paid every quarter. It's done really well the past 15 years that I've owned it, so I'm wondering if I should just leave everything as is. Kind of want something that's income producing and more conservative, but also I'm afraid to upset a good thing. Thank you. Any thoughts? Appreciate it.
What a dream scenario for somebody.
Yeah.
First of all, to be in the countdown and approaching retirement, to know when you're going to be able to step away from a paycheck, but then also to already be able to quantify and say, I know I'm going to have enough pension and enough Social Security income to cover my basic needs, my normal bills. That puts you in such a strong position because it means that either your investment portfolio is now going to be just sort of extra and an enhancement, or maybe you're leaving it intact for later years and you'll tap into it as needed, maybe when health begins to decline, or maybe there's future needs that you're not facing right now. So, man, again, kudos to you, as you said, Mike. That's awesome.
All right, so we can go deep and wide here, and you guys know we enjoy talking. Actually, we just enjoy this stuff. Like, we are so geeky. So, first question then is, so how much of your portfolio should you have in stocks when you retire? I just did a video on this on the YouTube channel, and that's where the question came from. And one of the rules of thumb out there that I was sort of bashing is you take 110 minus your age, and that's the percentage of your investments that should be in stocks. Now, John obviously has about 100% in stocks, and not just stocks, 100% in stock. Mm-hmm. But before we get there, guys, what do you think of the rule of thumb and the thought here of John kind of being outside that range?
Well, John's situation is the rule of thumb that says you shouldn't adhere to the rules of thumb.
Completely agree.
Because when you look at that, I love the idea. Now, if the issue is if John's company was General Electric, because General Electric went from being the dividend darling to absolute, when you look at the capitalization that stock lost, and how they stopped paying or reduced dramatically what they were paying in dividends, you would say, well, that is not working. Which comes back to your point, Mike. It's a company stock, and the problem is we are all hardwired to be horrible investors. If you can hear this today, you need to know you are hardwired. The three guys on the show, we are hardwired to be horrible investors. What happens when you work at a company? I saw this. I saw the clients that worked at Allied Signal, and Allied Signal ripped off, I don't remember. I think it was 30% a year for 10 years or something ridiculous like this. And even the janitors could tell me how amazing Allied stock was going to be moving forward. And then it got bought by Honeywell and went into this period of kind of morass, and it didn't perform like they were used to it performing. And when you have a company that performs like that, and maybe John's is one of them, you're used to that. And you say, hey, I've got a good dividend. Why would I interrupt a good thing? And the reason why is because you don't know the future. Concentration creates wealth. Diversification preserves it. So the question in my mind is not, should I take my company stock and now go buy bonds? It might be, should I take my company stock and go buy a number of other companies' stocks?
So diversify. Don't be so concentrated in one position, especially if you're no longer in the company. Not that an employee necessarily has quote unquote insider information. It's illegal to trade on non-public information, I realize, but you still, if you're in the company, you have a sense for how things are going. You are totally dialed in. You know exactly how the winds are shifting and so on. You have a better picture of how things are going. But also, as Kevin said, just because it was a great ride to get you to the size nest egg you have right now doesn't mean that it's going to continue to be the right tool to allow you to live off these assets in retirement.
Yeah. So I would blow up the rule of thumb, but I would also think about diversification as well. The question is this the conventional approach? Should you look at a different approach? So we've got more here to tackle, and then more questions from fans of the show coming up on the Wise Money Show with Korhorn Financial Group. Hello, YouTube. Thanks for being here. This is the Wise Money Show. What you're watching right now is our weekly 1-hour talk show that airs right here on this channel, 10 a.m. Eastern time every Saturday morning. Also on podcast at the same time, but also on a couple local radio stations as well, which is why we've got segments and why the content is long form and structured the way that it is. But don't fret. We've got Next Wise Step videos and other videos that air right here on this channel all throughout the work week, direct for YouTube, direct for your kind of this setup, 8 minutes, 6 minutes, 10 minutes long, taking one financial concept, applying it to your financial life. So make sure you hit that subscribe button, turn on notifications, and like the content. If you like the content, share it as well. We appreciate it. All right, let's pick it back up.
Okay, so the GE stock I bought in 2000, the market cap of GE was 575 billion. 575,000 millions. Today, it's 219 billion.
Hasn't quite kept up with the market.
Similar to my investment in gold. So it's amazing when you look at this because everyone has the story of the one company I invested in that was it just worked and it was amazing and this is where our family wealth came from and everything else.
Yeah.
But man, if you pick the wrong one,
Think Eli Lilly, kind of in our backyard. I go back. How far do you have to go back before Intel was like one of the companies that you wanted to own before it just sort of began to flounder for a while?
Yep.
So you never know how the trajectory of a business is going to change, and it's hard to imagine before it happens.
Yep. All right, here we go. Should you have all of your retirement dollars in dividend-paying stocks and have that be what feeds your income to supplement Social Security and a pension, or is that too much risk? We're talking about that right now. This is the Wise Money Show with Korhorn Financial Group. Thanks for being here. My name's Mike Bernard. With me in the KFG studios, Kevin Korhorn and Josh Gregory. Stay up to date on all Wise Money content. Find us online, wisemoneyshow.com. And then all over social media, wherever you're at, we are there as well. Search the Wise Money Show. This question came from John on the YouTube channel. Said all of his monthly bills are covered by Social Security and pension, and all of his investments are in his company stock that pays a dividend. Kind of want to leave it that way. Should I do that or make an adjustment? And first, we sort of glossed over it, but we just do not agree with the rule of thumb as far as 110 minus your age. That's how much you should have in equities. Instead, you need to look at your specific financial situation, financial goals. If you are not drawing anything out of your investments, and similar to John, you've got all of your monthly income covered by Social Security and pension, you really don't need to draw anything else out, you should be more aggressive. You should, no matter what your financial situation is. But if you can't stomach that ride, if you're in retirement and you just keep thinking about CNBC or Wall Street or whatever, then you're probably taking too much risk. So yes, it depends on your financial situation. It also depends on your kind of risk tolerance or your emotions. And so there isn't just a one-size-fits-all rule of thumb.
right? But the biggest component in that, Mike, is really my time horizon. Because if I don't need the money, then it's not risky to have it on the market.
Correct. It's not short term.
If I need the money today, it's risky to have it in the market. Josh, on the break, mentioned Intel. So the Intel stock you bought for $74.88 at its peak in 2000 is worth $25.69 today.
Ouch.
So that's 25 years later, it's worth a third of what I paid for it. And you say, well, wait a minute, because when you bought it in 2000, it had just had 1,000% run up in the share value. And you're like, how could anything go wrong with Intel?
And
Andy
Intel
Grove
They couldn't have paid you enough in dividends to make up for that kind of market decline, right? You have to own that thing for 3 lifetimes in order to make up that loss.
Here's the thing, though, and then we can get over to diversification and then another approach. I actually like John's setup. I mean, he's looking and saying, I like the income. I don't need the income. My cash flow. I mean, ideally, your 2/3 of your income need is coming from guaranteed sources in retirement. Ideally. Now I know that's rule of thumb, right? Is we're squashing rules of thumb. So that's why you don't hear us talking about that. We don't have any T-shirts made. But ideally, you have that much security in your income that it's covering your monthly expenses. And John has that. And so he could afford, I mean, this is not short-term money. He could afford for it to be fully in stocks or very heavily into stocks. And the fact that this one happens to pay a dividend, yeah, even better. There is the chance that this dividend darling, ends up not having a great ending to that story. And therefore, are you okay with that, John? How do you feel about that risk? If this company stock happens to pay a 4% dividend and the S&P 500 is paying a 1.3% dividend, maybe you need to look at diversifying with some other dividend-paying stocks that are in the 3 to 5% range. There aren't as many as there used to be, but I bet you could get some diversification that way.
Yeah. I'm picturing a client that is exactly their situation, where they have a number of individual stocks, many of them inherited from family members who were, again, growing a portfolio that was going to outlast them. And because of this, they could get even more diversified if they wanted to, but they're comfortable with the amount of concentration that they have. And they love the dividend income. They're not tapping into any of the principal. They're not selling off any of the shares in order to meet their lifestyle needs. And so, yeah, it's really purely an income play for them. And they're comfortable with whatever fluctuations may come by holding that many stocks.
That's where I would tell you, John, you got to sit down belly to belly with the CFP who's looking at your entire financial situation. Someone that you trust isn't just going to try and talk you out of what you have and talk you into whatever they have, but someone that can look and, hey, here are the pros, here are the cons, here's what's working, here are the risks, and then here's a few different ways that you could pivot and then help guide you to what makes the most sense. The other reason, and this is off topic, the other reason why you need to work with a CFP is NUA.
That's exactly where I was going to go to.
Yeah.
This bridges the gap between just making this an investment decision or a retirement income decision, and now it incorporates your tax picture as well. Because you mentioned that you're owning mostly company stock and that you have a 401k. I'm assuming that is the company stock in the 401k. And if you've held that for a long time and it's really run up in value and has not just been kicking off dividends, but has also been really appreciating, it's possible that there could be some tax strategy here. We did an entire show, or several segments at least, on net unrealized appreciation as a strategy for those in your exact situation, John. Someone who owns maybe a significant amount of company stock that has run up in value in their 401k. Is there some repositioning that could happen and maybe put you in a more tax advantaged position?
Yeah. All right, now I'm going to flip the script, even though you're probably like, will you guys move on to the next question? What if you're not in John's situation? You've got your $1 million saved up or whatever you have saved up, and it's diversified and all that. Should you sell everything and buy a dividend invested in a dividend paying stock and just live off of the dividend? No.
So go put yourself in John's situation.
No. I mean, what makes John's situation unique is with a Social Security and a pension. Most folks do not have a pension. Mm-hmm. And you say, well, what's a pension? A pension is where you stay on payroll, but you just don't have to show up anymore.
That's what I've been doing for a while.
I know. It's unbelievable. My dad has been on payroll at State Farm for 24 years, and he's not shown up. Yep. It's what a great deal. But it's not available to most folks. So if you if you were in John's situation, replicating it might make some sense. But this is where, because to me, where my mind was going, and forgive me for changing course just a little bit, the reason why John needs to talk to a certified financial planner is because he might say, hey, listen, I've just kind of been doing this myself. I got all this company stock. I love my company. I love my stock. Just leave me alone. That's fine. But here's the question. Number one, is the NUA possible? But also, is the next steward of these resources identified? Because I think about John and I think, well, here you go, John. You've got this. You might be able to take your dividend income, diversify what stock you own into stocks that you own, and take those dividends and just keep accumulating. You might be in an accumulation mode where your accumulation is going to run away and you'll never catch up with it. You'll never be able to spend it. We have lots of clients in that situation. Well, who's going to be in charge of that next? Because John might enjoy the financial complexity and say, I'm not interested in professional management. Not everyone can handle that. Not everyone maybe not everyone has John's tolerance, his stomach, to watch the share prices go up and down.
Before we go off of John's question here, I want to just make one more observation and maybe share this as a word of encouragement to some of our listeners. You're exactly right, Kevin, that most people don't have really big pensions, really big Social Security, and are able to live off of just that and leave their portfolio intact or maybe just draw dividends off of it. A lot of people can't achieve that, but people do. And sometimes it's with just Social Security alone. I have clients who they have maximized their Social Security benefits and they are able to live off of just the Social Security and let their portfolio be a supplement. And the only reason they can do that, here's the message to you, is because they are in control of their spending. Right. They are living within their means and always have, so it is just part of their habit. And that's a habit that you can begin building even right now. How do I live within my means no matter what? That's
a balance sheet play. So don't hear us saying, quit your job and go get a job with a pension. Hear us saying, fix your balance sheet. Because that's how you do what Josh is talking about.
Great question, John. We've got more questions from fans of the show. That and more coming up on the Wise Money Show with Korhorn Financial Group. Okay, good stuff. Third segment.
We're still not laughing.
I tried to make a joke in there. All right, going to Gary's. Probably get both, because Gary's first and second question are the exact same. Aren't they?
Does he really want that answer?
Yeah, I think it's the same. And then shoeboxing combined with a Roth conversion question. We're probably not going to hit both of those, but probably start the second one. All right, here we go. When you inherit an IRA from someone that's not your spouse, the rules have changed. And then what if that person that inherited it, what if they passed away? What are the rules then? We're helping with that right now. This is the Wise Money Show with Korhorn Financial Group. Thanks for being here. My name's Mike Bernard. With me in the KFG studios, Kevin Korhorn and Josh Gregory. Every episode of the Wise Money Show is on podcast. Wherever you listen, just search the Wise Money Show. Subscribe to it there. Rate the program there as well. We appreciate it. Hidden questions from fans of the show, and took a long time answering John's question about, and there's still meat on the bones there, guys, but we're gonna move on. But how do you structure your investments when you retire? And if you're living just on Social Security and pension, is it okay to have the rest of your portfolio in a dividend-paying stock? We'd want you to diversify. That is a great situation. If you can stomach the roller coaster, just be aware of the risk. If you're not in that situation, work with your certified financial planner. Build out your own personal pension plan so that your investments are structured based on the time horizon, diversification, and your risk tolerance, all set up unique for you. Next question here comes from Gary. It's technical. It's a good one. Questions about an inherited IRA. He's got two of them. I can't see the difference between the two, so I'm just going to hit it. An inherited IRA needs to be converted within 10 years of inheritance. It needs to be withdrawn. It can't be converted, by the way. We'll come back to that. What happens if the person who inherited the IRA also passes it away and it passes to the next person? Do they get a new 10-year? Does the 10-year clock start over, or does it still have to be liquidated in that original 10 years after the original owner's death?
Yeah, it's possible that Gary is aware that there used to be rules in place. We would refer to this strategy as a stretch IRA or the stretch IRA rules, where once upon a time, you could leave your IRA to a beneficiary and they could continue to keep it tax sheltered for their entire lifetime and then even pass it down to their beneficiaries and stretch it out even further. There would be all kinds of workshops and things showing the power of the math of basically what does it look like to be able to shelter money for multiple generations. It's pretty powerful. Unfortunately, when we got the Secure Act back in 2019, a lot of those strategies just kind of went out the window. And all of a sudden, we are now talking about these 10-year rules. And there was a lot of waiting around to see how those rules would actually be applied as well. But we have enough clarity now that we can say, yeah, when an original IRA owner passes away and they leave it to their beneficiary, that starts a 10-year clock ticking. And that 10-year clock passes on beyond even the beneficiary's lifetime. So if generation number 2 inherits the money but doesn't hold it very long before they pass away, and it goes down to generation number 3, there's not a new 10-year clock ticking at that point. It goes back to the original owner's lifetime, and you still have the original 10-year period to deal with here.
So it's just meeting with some folks where mom passed away in August of 22, and they've got until the end of 2032 to empty the account. The inherited IRA needs to be completely emptied. Mom was in her late 80s, was already taking her required minimum distribution, and therefore, in addition to this 10-year rule, they've got to take a required minimum distribution every single year as well. They calculate that RMD on their own life expectancy, not mom's. So in a way, there's like this mini stretch happening, but the account still needs to be emptied by the end of 2032, the end of the 10th year. If this individual, this client now, who was the beneficiary, if they pass away after 6 years, well, whoever inherits it, they've got beneficiaries listed, has to withdraw the account still by the end of 2032. So they would have 4 years. So it's the same 10-year clock. Yeah. But couple things. If you're inheriting an IRA from someone else or a retirement account from someone else, that is a financial planning discussion. That's a financial planning issue, because just because you can wait 10 years, should you wait 10 years? This exact individual I'm talking about, she's single, and she's in the 24% tax bracket. She can't stand what she does. And she's able to retire in her mid-50s. And so she keeps going back and forth, will I retire, will I retire? And to us, it is, all right, should you just take out the minimum amount, your required minimum distribution, or should you take out 1/10 so that you don't have this unusually large amount of income land in one specific year?
And that's a good point to make, that if the government requires that you take a required minimum distribution each of those 10 years, it is not 1/10. That's not the calculation. It's a much smaller amount. And so if you take the minimal amount out for 9 years in a row, in that 10th year, there's a big pile still left in that account, especially if it's continued to grow and accumulate and everything. And so what you may be setting yourself up for is a little bit of tax impact along the way for 9 years, and then a monster impact in the 10th year. And what if in that 10th year you have other tax forces at work against you as well, and you suddenly are throwing yourself not into the 24% bracket, but something much higher, and also creating things like more premiums to pay for Medicare and all of that. All of this is avoidable if you're planning ahead and working with your certified financial planner to have a multi-year tax plan in place.
Yep. The other thing that I would mention, again, going back to if you are inheriting an IRA from someone, you need to also double check to make sure, does the 10-year rule apply to you? You have to assume that it does. But there is something in the new law, Secure Act 1.0, an eligible designated beneficiary. Blah. That's a mouthful.
Yeah.
And who are those? Those are the folks that get an exception. Those are the folks that can still play by the old rules and can stretch it out, and the 10-year rule doesn't apply to them. Now, it's not a blanket definition. It's very specific, but you need to see if that applies to you as well. So anytime you're inheriting an IRA, planning issue, be working with your CFP. Okay. All right.
But I just think, especially your CFP for the 10-year tax plan, because if someone gives you an inheritance and it's an IRA that's a traditional IRA, never had taxes paid, it's a 10-year clock, and you really want to look at over the next 10 years when and how much should I pay in taxes, and how do I arrange my financial life? Mike, you said that the client you're referring to might want to do a career change or just flat out retire. Well, what does that look like? And if you moved the inherited IRA to the front of the line, what would you do with the other stuff? Yeah. I don't know. You might just put it 100% in company stock and receive the dividend.
The other thing is if she does retire early, she's going to need health insurance. And if she needs health insurance, so it's kind of like if you give a mouse a cookie sort of thing. Like if she's going to need health insurance, then we have to keep her income really low. Well, if we have to keep her income really low, should we draw more out of this inherited IRA than just the minimum along the way as well? Like this is, boy, that's why I love planning. I absolutely love it.
Especially you love planning when you've got generational wealth in a complex situation and you can say, hey, let's decide who's going to pay these taxes.
Yeah.
And then you create a plan and execute.
All right, we're going to introduce the next question here. Comes from Brian from the website. I've got a health savings account. I contribute the maximum every single year. Awesome. Way to go. I shoebox my receipts and don't use the money in my account, but I pay expenses out of pocket. Love it. When I retire, still 25 years away, if I would reimburse myself for previous medical expenses from my HSA and use that as my income for my first year of retirement and have no other working income, would I have zero tax liability? And then if so, could I then roll over my pre-tax 401k to a Roth and pay no taxes on the rollover? So, okay, lots of layers to that question, and I love it. I love the proactive thought process, the proactive approach. I love the advanced strategy that you're applying here, shoeboxing. Just to circle back, not that it matters, but just to avoid confusion. So in the previous question about the inherited IRA, Gary mentions that you have 10 years to convert the inherited IRA. Nope, you can't convert an inherited IRA. You've got to withdraw it. It's just a withdrawal.
Yeah.
And then the other, if I roll over my pre-tax to my Roth, that's what a conversion is. That's a conversion, a unique strategy there. So, all right, just wanted to lay that foundation so we avoid confusion. We're going to answer the question, that more coming up on the Wise Money Show with Korhorn Financial Group. I'm not trying to police this stuff, but I also don't want to create confusion.
That's right, because some people might hear it and think literally that's what they meant.
Well, dude, that question just created confusion. But I'm happy to summarize it and then kick it off.
Yep. I was also looking, we can't really start answering the question. We got 35 seconds. So what can I say?
You're good. You're good.
All right, fourth segment.
Oh,
Yep.
This is the fourth?
Yeah, this is fourth.
I am horrible. Every show would be 5 segments if I was in charge. Every time.
I think you were one time.
All right, here we go. Land the plane. Thanks for being here. This is the Wise Money Show with Korhorn Financial Group. My name is Mike Bernard. Here with me in the KFG studios, Kevin Korhorn and Josh Gregory. Every episode of the Wise Money Show, as well as a lot of other content, is on the Wise Money YouTube channel. Go check it out. What are we, over 1,500 videos or just something wild? Lots of views, millions of views and all that sort of stuff. So go to YouTube, search the Wise Money Show, tons of content. If you are facing a financial issue, question, want to do some research, odds are we've created content that can help you take your next wise step and prepare you for your next discussion with your certified financial planner. So go to YouTube, search The Wise Money Show. Subscribe to it there. Hitting questions from fans of the show. Brian's question, I'll just reintroduce it here. I max out my HSA every single year. I then shoebox my receipts, meaning I just pay for medical expenses out of pocket and let my money continue to grow in my HSA. When I retire in 25 years, if I were to then pull the money out of my HSA in that year, I would have no income. And then could I convert my pre-tax IRA to my Roth and pay no taxes on that rollover? Whew. There's a lot of dimensions there. What do you want to tackle first?
I would start by just a few explanations. First of all, an HSA is a health savings account, and you are eligible to fund that if you have a high deductible health plan. When you fund that, you can either fund that and put it in a savings account, and if you're putting it in a savings account, you're probably using it as you go. So
specifically a health savings account
yes,
that
thank you.
is funded with savings type vehicle, right?
Yes. There is the story of the person that was told, go fund. You're eligible to do a health savings account. Go put this money in the bank in a savings account and reduce your tax liability. They went, put the money in their savings account, not their health savings account, their savings account, and expected that they would get the reduction, and instead they got a nasty gram from the IRS saying, hey, you never funded an HSA for last year. So an HSA is an account. It can be in cash in an HSA account, or it can be invested in an HSA account. I was just at Everwise yesterday, and here's a little confession, the cobbler's kid without shoes. I had $23 in an HSA that I'd had there from years ago, and I've probably been meaning for the last 10 years. Every time I get a tax notice saying, hey, this is your balance, here's your 1098 or whatever, I'm like, I need to cash this out. Well, the two gals that I was talking to about the HSA, their company, Everwise, makes a contribution into the HSA for them. And I said, hey, you gals are young. Do you know that you can invest that money? They had no idea. So there are a lot of things that you want to know, but really this is the long way of saying, Brian is saying, hey, I'm building this account which will allow me to flatten out my income. If I flatten out my income, is there a strategy that I can do if I have zero income? And yes, there is a strategy that you can do to create income, which is not earned income.
Mm-hmm. It's implied here that Brian is using the second of the two HSA options that you were referring to.
Correctamundo.
Because if you're going to just let money accumulate in the HSA and you're not going to reimburse yourself from year to year as you have real-time medical expenses, then allowing it to accumulate really only benefits you the most if you're allowing it to grow and compound. Yeah. So use investments over time. It effectively becomes like another retirement savings vehicle for you. And I think what Brian is saying is when I go to finally reimburse myself and cash in those dollars that I could have been paying myself all along, it's not going to be income to Brian. He's going to get a bunch of cash to be able to live off of, but not have to count it on his tax return, which is a pretty sweet deal. And you might just say, well, man, that's going to be the best year of my life. I'm going to get all this money dropped in my lap and have no tax. Like, who wouldn't sign up for that, right? But Brian, I must be a Wise Money listener regularly, because we don't like to see zero tax years. We like to see optimal tax years. And what Brian is saying is, man, if I have a year where I don't have any other income, what if I go artificially create some income on my tax return by doing something proactive? And his mind was going to a Roth conversion, which we talk about on the show all the time. It is a way to create income where there didn't have to be income. Take money that is in your 401k or a traditional IRA account, never been taxed along the way, and now you want to pay the tax in an ideal year. And Brian's got an ideal year lined up, doesn't he? Yep. So he could choose how much money to take out of that taxable IRA account, move it into a tax-free Roth IRA, and the amount that gets moved presumably all of it would be counted as income, which means he has the power to very precisely decide how much income is going to land on the tax return. He gets to pick his tax bracket. He's in complete control. Brian, if you were in the room, it'd be all high fives for you right now.
And yet one thing I want to make sure isn't being implied here, that, okay, well, now that I don't, in my first year of retirement, just drawing money out of the HSA, now I don't have any income. Therefore, I can convert as much as I want and be in the 0% tax bracket. No, the conversion is taxable. It counts as taxable income. And therefore, if you have no other income, and then you do a 50,000 Roth conversion, 50,000 is going to show up as income. You'll get your standard deduction. You'll pay tax on the difference. It's not that, well, I'm in the 0% tax bracket, so therefore I can move 50 grand and it won't have any tax consequence. Roth conversions are taxable. So, yeah, work with your CFP, get precise, figure out if this is just a one-year strategy, if it's a multi-year strategy. Absolutely love it. So, all right, next question here, probably the last one we're going to be able to hit. Question comes from Dan. Can I send taxes to the government for Fed and state from my IRA and have that count as my RMD? Can I do that? And then do a Roth conversion? He's like, he said, I'm not going to turn 73 for a couple more years, but I'm trying to plan ahead for my RMD. Really appreciate the answers on the show. I listen every single week. So thanks, Dan. Appreciate that. Yes. We absolutely love it. Okay, so you cannot do a Roth conversion with your required minimum distribution. So the timing's super important here. Most people hear that and say, oh, well, once I turn 73 and I'm required to make a minimum distribution from my pre-tax accounts, I can't do a Roth conversion. Yes, you can. But you have to do your RMD first. If you are proactive and look and say, yep, I want to still do a Roth conversion. I'm still in the 12% tax bracket, or I'm still in a tax bracket I want to pay tax on. Let me calculate how much would I convert, what's my RMD, what's the total tax, and then take your RMD out and send it all to taxes, and then do your Roth conversion and don't send any of it to taxes. You've then covered your taxes, you've done a Roth conversion, and you've maximized the amount of that Roth conversion that lands in your Roth IRA. Everything's confidential. I'm just going to say, do this with some family members of mine who every single year we just look, hey, what's your RMD? Okay, we're going to send, they happen to live in Florida, we're going to send 100% of that to the Fed. All right, that means we've got a bunch on deposit for the taxes we're about to create from this Roth conversion. All right, let's do a $50,000 Roth conversion or whatever it is. And bam, you're paying the taxes on your Roth conversion from your RMD, maximum amount now in your Roth, growing tax-free.
Yeah, and the order matters, as you pointed out. So you are essentially prepaying some tax on income that you haven't created yet. And it's all so that you can check the box and satisfy your compliance rules that you have achieved your required minimum distribution for the year. Once the required minimum distribution is handled, either through this method, like sending dollars off to the government, putting them in your own pocket. You could even do a qualified charitable distribution as a way to check the box and say, my RMDs are done. Now, let's have a conversation about, should we also do a Roth conversion that year? And I love the strategy because you've got essentially a big old coupon of taxes that have already been paid, but no income to kind of mop that up with. Mm-hmm. And the Roth conversion creates that income. It kind of completes the whole cycle for you as long as you do it in the right order.
Lots of great planning there.
Yeah.
Lots of great planning.
And the other thing that I like about it, Dan, is you're a couple years away from RMD and you're thinking about it. Mm-hmm. And I would tell you, not only if you're a couple years away, but if you're a decade away, if you're 2 decades away, should you be funding Roth 401k or pre-tax based on your situation? Should you do a Roth conversion this year so that you avoid your RMD out there in the future and potential consequences with IRMA? That's the proactive work that you need to be working with your certified financial planner on. They should be looking at all 6 areas of your financial life and giving you those creative strategies to help you get there. So work with your CFP on that. That's all the time we have for today. On behalf of Josh and Kevin, all of us at KFG, have a great weekend. We'll see you next Saturday for the Wise Money Show with Korhorn Financial Group.
Securities offered through Silver Oak Securities, member FINRA/SIPC. Advisory services offered through KFG Wealth Management LLC. Doing business as Korhorn Financial Group. KFG Wealth Management LLC and Silver Oak Securities Incorporated companies are unaffiliated.